Robschild. No investment advice. Welcome to the show where we view financial markets through crystal ball gazing. Today is Tuesday, September 3rd, 2024. Specifically today, after a 3-day weekend, oftentimes you get what some market participants consider to be a hangover day, where volume is kind of light and nothing really happens too dramatically, but we had a pretty dramatic day today. And we'll go over that. And main thing of today's episode is stock market really breaking here and some trends changing. A pretty interesting day. Notably, tomorrow on Wednesday, we also have the job openings, the last reading of this being 8.18 million. This could really, if this comes in super weak, and we start seeing more and more evidence of major slowdown, we could see markets continuing to crack tomorrow. And then the really big, huge number that everyone is waiting for is Friday's unemployment rate, jobs rate. The unemployment rate, last reading of this for the last month's reading was 4.3%, high enough from the previous reading to trigger the SOM rule, which indicates that unemployment is rising at an unsustainable pace. And daily reminder, before we go into the charts, 2-year, 10-year Treasury curve was inverted for over 2 years, now flat, exactly flat again today. If you remember, on Friday, it was the first day that they were equal, the 2 and the 10-year. The question is, do we now uninvert? And when that happens, that's a typical telltale sign that the recession is here, basically. So we can start with looking at that. This is the U.S. Treasury yield curve. If you look at the 2-year, it is at 3.91, and the 10-year also at exactly 3.91%. So we haven't exactly uninverted yet, but we're bumping our head on zero now after not having crossed it or bumped our head on it for more than 2 years. 2 years and about 2 months, actually. S&P 500, SPX. I mentioned on Friday the green candle here was a mini breakout to the upside, and I said I would eat my own hat if we broke above the all-time high, and so I don't have to eat my hat, luckily, because markets really flushed out today pretty good, on pretty good volume. The hangover effect did not occur. Market participants really flushed out today. As a whole, with the S&P 500 being so overvalued at a PE ratio of almost 30, along with starting the cutting cycle of the Fed, along with the SOM rule triggered, along with the uninversion of the 2-year, 10-year yield curve, all signs point to this making complete sense for the market to start showing weakness here. And like I said at the intro, we might possibly and probably, in my opinion, have that confirmed on Wednesday's and Friday's data incoming. A flush of over 2% in one day on the S&P 500, so pretty large move to the downside, looking like it is fairly bearish now. So, and this head and shoulders top is still in play. I've been mentioning it ever since we started climbing this shoulder, and so far it looks like it will be playing out how I drew it. To negate the pattern, we need a new all-time high in the S&P 500, and I don't see that coming in my crystal ball. Looking at the S&P 500 on a weekly candle time frame, just this one trading day of Tuesday formed so far this very large red candle after a hammer candle. Now, let me move this out of the way so you can see it better. And so it's just playing out like clockwork, in my opinion, and that this will be the top, the head and shoulders top here. Same thing obviously going on in the NASDAQ, the triple Qs. We had, over a 3% drop in the NASDAQ today. Nvidia was a big part of this. I thought I saw a headline, it dropped something like 10% today, which is a very, very large move for Nvidia. And so the SMH, the semiconductors index, also dropped by 7.5%. Very, very, very large move to the downside. VIX futures curve, we had a pretty big up day in the VIX today. If we take a look at the actual VIX, relative to the previous VIX pop, it doesn't look like a very large candle. But if we removed this previous market major volatility event, today's VIX would look very, very large. 38% gain in the VIX today. That's a massive move to the upside. And then looking back to the VIX futures curve, the market still expects more volatility in October, as it has been for more than 6 months now. I mentioned on Friday TLT looking like bonds were bearish, like they were headed down. I thought maybe we were going to head down to this support line here from Friday's candle, but today kind of negated that. We didn't even flag here or anything. We just popped right back up. This is what we call a blow-off bottom. And so TLT is now looking fairly neutral, if anything. Or you could even consider this to be a popping right back into this previous bull flag channel that we had been developing, suggesting that bonds, they're showing pretty good strength here, actually, from a trendline analysis. HYG had a dividend X date, and so part of the movement down in HYG has to do with money being taken out of the fund. However, if we also look at PFF, preferred shares fund, this showed some weakness too. This basically functions just like junk bonds, and had a pretty good break today. And so there is legitimate weakness showing up in markets. When you have treasury bonds going up and lower grade bonds going down, that's risk off. That's like credit spreads are like widening a little bit finally. If you've been following the show, you've been hearing me talk often about how scary I think it is how tight credit spreads have been getting. And so finally, Mr. Market is waking up a little bit to the risk involved with higher risk bonds or bond-like securities. The last very notable chart of the day is oil. We had a very large and formidable break to the downside in oil, 5% drop in one day. Oil is a very good leading indicator as far as where things are headed, and usually coincides with yields dropping as well. And so this is a good time for bonds and not such a good time for a whole lot else, in my opinion. At least right now it seems that way. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.